The Reserve Bank of Australia made a choice in 2022 that would reshape the wealth of every Australian, but not equally. Some people got richer while others got buried. When the RBA started hiking rates from near zero, they weren't thinking about you specifically. They were fighting inflation. But the outcome was precisely this: wealth redistribution by policy. Property investors who already owned assets watched their equity balloon. A Sydney investor with a $2 million property gained $400,000 in paper wealth in just 2 years, even though they paid nothing for it. Meanwhile, a first-time buyer who was saving for a deposit watched the goalpost move further away. The deposit they needed grew faster than they could save it. Renters faced a different trap. Landlords responded to rising interest costs by raising rents, passing the mortgage burden straight on to tenants who had no say in the decision. But here's where the story gets more complex. Elderly Australians on fixed incomes finally had something to celebrate. Bank deposits that paid almost nothing suddenly yielded 4, 5, even 6% returns. Young workers saw their real wages decline. Inflation rose faster than pay increases, meaning they earned less in purchasing power even though their salary numbers went up. The mechanism is almost elegant in its cruelty. Higher rates boost asset prices for people who already own assets while squeezing the cash flow of people trying to acquire them. The RBA claims this was necessary to control inflation, and technically they were right, but the cost was redistributed to those least able to bear it. Negative gearing, a tax loophole that lets investors deduct losses from their taxable income, meant that wealthy property investors didn't just benefit from rising prices, they got government subsidies while doing it. A bank worker in Melbourne earning $65,000 a year paid more tax than a property investor earning $200,000 in rent plus $150,000 in paper gains because the losses were deductible. The political reason this persists is blunt. Most wealthy Australians benefit from negative gearing, and they vote, donate to campaigns, and own media. Young Australians now face a calculation: buy at inflated prices using a mortgage that will dominate their entire working life, or rent and accept permanent insecurity. Some economists argue the system is already broken. Property prices can't keep rising indefinitely, and when growth stops, the wealth transfer reverses. But here's the uncomfortable truth. Even if prices crash, the damage is already done. A generation has already been priced out, already carries stress, already made decisions under artificial constraints. The RBA will tell you they didn't intend for this to happen, that monetary policy affects everyone equally, but it doesn't, and they know it. The wealthy use leverage, borrowed money, to amplify their gains from rising prices, while ordinary people use leverage just to afford a basic home, and interest rates hit the latter far harder. When the RBA raises rates by 1%, a bank might increase mortgage rates by 1.2%, but deposit rates rise much more slowly, if at all. This isn't accident. It's how banking oligopolies work in concentrated markets like Australia, where 4 banks control most lending. So who actually won from the RBA's rate hikes? Property investors, existing homeowners with equity, retirees with savings, and multinational banks. And who lost? First-time buyers, renters, young workers earning wages that can't keep up, and anyone who doesn't own assets. The RBA had a choice: raise rates aggressively to control inflation, or raise them slowly and accept higher inflation, and they chose the path that favored asset owners. Some argue they had no choice. Inflation was threatening financial stability. But that argument ignores that financial stability for the wealthy is now dependent on financial instability for everyone else. The superannuation system compounds this. Australian retirement savings are required to be invested, largely in property, meaning your pension is now directly dependent on continued property price growth. If property prices stagnate, millions of Australians won't have adequate retirement income, so the system is structurally betting on perpetual property appreciation, something that is mathematically impossible forever. So the RBA's rate hikes didn't just redistribute current wealth, they mortgaged future stability by making the entire system dependent on outcomes that can't sustain indefinitely. The cruelest part is that ordinary Australians absorb this risk in no choice of their own. They need somewhere to live, so they participate in the system that's rigged against them. The RBA will make rate decisions in coming months, and each one will reshape who wins and who loses, often invisibly, but always systematically. Understanding this, that monetary policy is not neutral, that your pain or prosperity is often determined by decisions you didn't make and can't influence, is the first step to demanding change.